Mutual funds are a popular way to invest. They offer a convenient and accessible method for individuals to grow their money. They pool money from many investors, creating a large sum that can be invested in various assets. This money is then used to buy a variety of stocks, bonds, or other securities, providing a diversified portfolio. This means you don't have to pick individual stocks yourself, which can be stressful and time-consuming. Investing in mutual funds is like having a basket of investments, spreading your risk across different assets. This basket is managed by professionals who have the expertise and experience to make informed decisions. They make the decisions on what to buy or sell, aiming to maximize returns and minimize risks. This makes mutual funds a good choice for beginners who may not have the knowledge or time to manage their own investments. One of the best things about mutual funds is their simplicity. They are easy to understand and straightforward to invest in. You can buy them through a broker or an online platform, making them accessible to everyone. Plus, they are regulated, which helps protect your money and ensures transparency in how the funds are managed. Mutual funds can help you grow your wealth over time, providing a steady and reliable way to build your financial future. They offer a way to invest without needing to be an expert, making them suitable for a wide range of investors. This makes them a great option for anyone looking to start investing, regardless of their financial background or experience. There are many types of mutual funds available in the market today. Each type of mutual fund has its own unique focus and investment strategy. The most common types of mutual funds are stock funds, bond funds, and index funds. Stock funds primarily invest in stocks, which are shares of ownership in companies. They aim for higher returns but come with more risk due to the volatility of the stock market. Bond funds, on the other hand, invest in bonds, which are essentially loans made to corporations or governments. These funds are usually safer, but offer lower returns compared to stock funds. Index funds track a specific index like the S&P 500, which includes a broad range of companies. They aim to match the performance of that index, providing a diversified investment option. Each type of mutual fund has its own set of pros and cons that investors should consider. Stock funds can grow your money faster due to the potential for high returns. However, they can also lose money quickly if the market takes a downturn. Bond funds are more stable and less volatile, making them a safer investment. They are particularly good for conservative investors who prioritize capital preservation. Index funds offer a mix of both stock and bond characteristics. They provide a balanced approach, combining the growth potential of stocks with the stability of bonds. Index funds are generally less risky than stock funds, but can still offer good returns over time. Understanding these different types of mutual funds can help you make an informed decision and choose the right fund for your financial goals. Mutual funds offer many benefits. One of the biggest is diversification. This means your money is spread across many investments. This reduces the risk of losing money. Another benefit is professional management. Experts manage the funds. They have the skills and knowledge to make good investment choices. This takes the pressure off you. Mutual funds are also very liquid. You can buy or sell them easily. This makes it simple to access your money when you need it. Plus, there are many options to choose from. Lastly, mutual funds are cost-effective. They have lower fees compared to other investment options. This means more of your money goes towards growing your investment. One proven strategy is long-term investment. This means holding on to your mutual funds for many years. Over time, the market tends to go up. This can lead to significant gains. Long-term investing can help you ride out market fluctuations. The market can be volatile in the short term, but it generally grows over the long term. This strategy requires patience and discipline. Compounding is another benefit of long-term investing. This means your earnings generate more earnings. Over time, this can lead to exponential growth. The longer you invest, the more you can benefit from compounding. To succeed with this strategy, stay committed. Don't panic during market downturns. Keep your money invested and let it grow. This approach can help you build wealth over time. Section 5. Dollar cost averaging. Dollar cost averaging is another effective strategy for investors looking to minimize risk and maximize returns over time. This means investing a fixed amount of money regularly, regardless of the market's ups and downs. For example, you might decide to invest $100 every month, no matter what the market conditions are. This approach helps you buy more shares when prices are low and fewer shares when prices are high, averaging out your cost over time. By doing so, This strategy reduces the impact of market volatility on your investments. It helps you avoid the common mistake of trying to time the market, which can be very difficult and often leads to poor investment decisions. Instead, you invest consistently, regardless of whether the market is up or down, ensuring a disciplined approach. Dollar-cost averaging can also make investing more manageable and less stressful. You don't need a large sum of money to start investing with this strategy. Small, regular investments can add up significantly over time, helping you build a substantial portfolio. This makes it easier to stick to your investment plan and achieve your financial goals. To use this strategy effectively, set up automatic investments through your bank or brokerage account. Many brokers offer this feature, making it simple to automate your investments. It ensures you invest regularly without having to remember each time, providing peace of mind. This can help you build wealth steadily over the long term and reduce the overall risk of your investment portfolio. Section 6. Real-life example, John's journey. John is a new investor. He decided to invest in mutual funds. He chose a mix of stock and bond funds. He wanted to balance growth and stability. John used the dollar-cost averaging strategy. He invested $200 every month. Over time, he saw his investment grow. Even when the market went down, he kept investing. This helped him buy more shares at lower prices. After 5 years, John's investment had grown significantly. He was happy with his returns. He realized the power of regular investing and staying committed. His patience paid off. John's journey shows how simple strategies can work. By staying consistent and patient, he achieved his financial goals. His story is a great example of how anyone can succeed with mutual funds. Section 7. Case study, Sarah's success. Sarah wanted to save for her children's education. She decided to invest in mutual funds. She chose index funds for their balance of risk and return. Sarah used a long-term investment strategy. She invested a lump sum and added more money whenever she could. She also reinvested her dividends. Over the years, her investment grew steadily. Sarah faced market downturns, but she didn't panic. She knew the market would recover. Her patience was rewarded. After 15 years, she had enough money for her children's college. Sarah's success shows the importance of staying committed. By focusing on her long-term goals, she achieved them. Her story is an inspiration for anyone looking to invest in mutual funds. Section 8. How to select the right mutual fund. Choosing the right mutual fund is crucial. Start by defining your goals. Are you saving for retirement, a house, or your children's education? Your goals will determine the type of fund you need. Next, consider your risk tolerance. Can you handle market ups and downs? If not, choose safer options like bond funds. If you can take more risk, stock funds might be better. Research is also important. Look at the fund's performance history. Check the fees and expenses. High fees can eat into your returns. Choose funds with low fees and good performance records. Finally, diversify your investments. Don't put all your money in one fund. Spread it across different types of funds. This reduces risk and increases your chances of success. Section 9. Common mistakes to avoid. Investing in mutual funds can be rewarding, but there are common mistakes to avoid. One mistake is not doing enough research. Don't invest in a fund just because it's popular. Make sure it fits your goals and risk tolerance. Another mistake is trying to time the market. It's hard to predict market movements. Instead, focus on long-term strategies like dollar-cost averaging. This reduces the risk of making poor decisions based on short-term market changes. Avoid putting all your money in one fund. This increases your risk. Diversify your investments to spread the risk. This can help protect your money during market downturns. Lastly, don't ignore fees. High fees can reduce your returns. Choose funds with low fees. This ensures more of your money goes towards growing your investment. Section 10. The role of financial advisors. Financial advisors can be very helpful. They provide expert advice tailored to your needs. They can help you choose the right mutual funds and develop a solid investment strategy. Advisors can also help you avoid common mistakes. They have the knowledge and experience to guide you. This can save you time and money in the long run. It's important to choose a reputable advisor. Look for someone with good credentials and experience. Ask for recommendations from friends or family. Check their track record and fees. Working with a financial advisor can give you peace of mind. They can help you navigate the complexities of investing. This can increase your chances of success and help you achieve your financial goals. Section 11. Conclusion and actionable tips. Investing in mutual funds can be a great way to grow your wealth. It's important to understand what mutual funds are and how they work. There are different types of funds to choose from, each with its own benefits and risks. Using strategies like long-term investment and dollar-cost averaging can help you succeed. Real-life examples show that these strategies work. Staying committed and patient is key. When selecting a mutual fund, define your goals and consider your risk tolerance. Do your research and diversify your investments. Avoid common mistakes and consider working with a financial advisor. In conclusion, mutual funds offer a simple and effective way to invest. By following these tips, you can make informed decisions and achieve your financial goals. Start investing today and watch your money grow.